It's 11:47 p.m. You're lying in bed, phone glowing in the dark, and you just type the same 4 words into the search bar again. Best investment for beginners. You've typed it before. Maybe last month. Maybe last year. And every single time, you close the tab 20 minutes later, feeling worse than when you opened it. Not because you didn't find answers. You found 40 of them, contradicting each other. And somewhere in the back of your mind, there's this quiet, nagging voice that says you're already too late. 35, 38, 42. Whatever your number is, it feels like everyone else got the memo in their 20s, and you're just now showing up to a party that's already over. Here's what I want you to know before we go any further. That voice is lying to you, not exaggerating, lying. And by the end of this video, you're going to understand exactly why starting now, at your age, with your income, with your life experience, is not the disadvantage you think it is. We're going to walk through the 5 most common mistakes that keep smart, capable adults frozen in place for years, sometimes decades. And I'm going to give you a simple, honest framework for choosing your very first investment, without the jargon, without the hype, and without pretending there's a secret formula that only rich people know about. There isn't. What there is a pattern of small, boring, repeatable decisions that compound into something real. And once you see that pattern, you can't unsee it. So take a breath. You're not behind, you're just about to start. Let's get into it. Let me tell you why I actually made this video, because it wasn't some marketing team's idea. I've had this same conversation, almost word for word, with a dozen different people over the last 2 years. A guy named Carlos, 41, works in logistics, told me he'd been about to start investing for 6 years running. 6 years. Not because he didn't care, because every time he sat down to actually do it, the sheer volume of conflicting advice made him feel dumber than when he started. So he'd close the laptop and tell himself he'd figure it out later. Later kept becoming later. And I want to be really direct with you for a second, because I think you deserve directness more than you deserve comfort right now. The financial industry, a lot of it anyway, doesn't actually want this to feel simple. Complexity sells subscriptions. Fear sells newsletters. Urgency sells courses. So you get bombarded with jargon, with contradictory hot takes, with people yelling about the next big thing. And somewhere in that noise, the actual basics, the stuff that genuinely works, gets buried under content designed to keep you anxious and scrolling. This video is the opposite of that. No countdown timer. Nothing to buy at the end. Just the mechanics. Laid out plainly, the way I'd explain it to my own brother if he called me tonight and said, "Okay, I'm finally ready. Where do I even begin?" And one more thing before we start, because I think it's important you hear it from someone, not just an algorithm. You are allowed to feel 2 things at once here. You're allowed to feel a little embarrassed that you haven't started yet, and also feel genuinely excited about starting today. Those 2 feelings can sit in the same chest at the same time. Don't let the embarrassment talk you out of the excitement. No fluff after this point. Just the walkthrough, start to finish, exactly as promised. Let's deal with the elephant in the room first, because if we don't clear this out of the way, nothing else in this video is going to land. You are not too late. I know it doesn't feel that way. Every headline, every app notification, every cousin at Thanksgiving talking about their portfolio makes it feel like there's a train that already left the station, and you're standing on the platform, watching the taillights disappear. But here's the thing nobody tells you. Starting later actually comes with 3 advantages that a 22-year-old simply does not have. The first is income stability. At 35, 40, 45, you likely have a clearer picture of your earnings, your expenses, your obligations. You're not guessing month to month the way you were a decade ago. That stability is not nothing. It's the foundation that lets you invest consistently instead of sporadically. And consistency, not timing, is what actually builds wealth over time. The second advantage is self-knowledge. You've been burned before. Maybe by a job that didn't work out, maybe by a purchase you regretted, maybe by trusting the wrong person's advice. That history isn't baggage, it's data. It means you're far less likely to fall for the flashy, too-good-to-be-true stuff that wipes out inexperienced investors in their 20s. And the third advantage, the one people almost never mention, is urgency. A gentle, useful urgency. When you're 22, you have so much runway that procrastination feels harmless. When you're 35 or older, that runway is visible enough that it actually motivates you to act instead of endlessly delaying. So flip the story in your head right now. You are not a late starter. You are a well-positioned starter who simply hasn't started yet. Those are two very different things, and only one of them is true about you. Let me give you a number that might genuinely surprise you. Historically, the difference between starting to invest at 25 versus 35, assuming similar monthly contributions, is real, but it is nowhere near as catastrophic as the anxiety in your chest makes it feel. 10 extra years of compounding matters. Sure, nobody's pretending it doesn't. But panic isn't a strategy either, and the version of this story where you spend the next 10 years frozen because you're mourning the first 10 does far more damage than simply starting today and letting the next 20, 30, even 40 years do their work. There's also something quietly practical about starting later that almost nobody talks about on finance content. Your spending habits, at this stage of life, tend to be more established, more predictable. You already know roughly what a normal month costs you. You've likely already been through at least one financial scare, a layoff, a medical bill, a slow month, and you survived it. That survival isn't just a memory. It's proof, actual lived proof, that you can adapt when things get hard, which is exactly the skill that keeps people invested through a market downturn instead of panic selling at the bottom the way so many newer, younger investors do the very first time the market gets scary. Think about someone you know personally, not a celebrity, not an influencer, just someone in your actual life who seems financially steady. Chances are, it's not because they picked one brilliant stock at 22. It's almost always because they built a boring, consistent habit and simply never stopped doing it, year after unremarkable year, long after it stopped feeling new or exciting. Mistake number 1, and this is the one that traps more people than any other single thing on this list: waiting for the perfect time to start. I want you to notice something about that phrase. The perfect time. It sounds responsible. It sounds like patience, like wisdom, like you're being careful with your money instead of reckless. But let's be honest with each other for a second. Most of the time, I'm waiting for the right moment is just fear wearing a disguise. It's analysis paralysis dressed up as due diligence. You tell yourself you'll start once the market calms down, once you've read one more book, once you've saved a little more, once things at work settle. And here's the cruel part. There is never a moment where all of those conditions line up at once. Never. The market doesn't calm down, it just changes shape. Life doesn't settle, it just rearranges itself into a new set of demands. Meanwhile, every month you wait isn't a neutral, safe pause. It's a cost, a real, calculable cost, because money that isn't growing is quietly losing value to inflation while you deliberate. Think about it like a garden. Nobody says, "I'll plant this tree once conditions are absolutely perfect," because they understand the tree needs years to grow regardless of when you put it in the ground. The best time to plant it was years ago. The second best time is today, not some hypothetical Tuesday in the future when everything magically feels ready. Waiting for perfect isn't a strategy, it's the absence of one. I want to give you a mental trick that actually works here, because knowing you're stuck isn't the same as knowing how to get unstuck. Ask yourself this question honestly. If I imagine myself 1 year from today, having started with even a small, imperfect amount, versus 1 year from today having waited for the perfect moment that still hasn't arrived, which version of me is in a better position? Say it out loud if you have to. 9 times out of 10, the honest answer makes the decision obvious immediately, because the perfect moment version of you hasn't actually gained anything from all that waiting except more waiting. There's a concept in behavioral psychology called the intention-action gap, the space between deciding you should do something and actually doing it, and it grows wider every single day you don't act, not narrower. The longer you wait, the more the decision calcifies into a kind of identity: I'm someone who's going to start investing eventually, instead of I'm someone who invests. Those are two completely different people living in your head, and only one of them ever actually builds anything. The fix isn't more research, 90% of the time, you already know enough to take the first small step. The fix is picking a specific day. This week, not soon. And treating it the way you'd treat a doctor's appointment you can't casually cancel on yourself. Mistake number 2. Investing before you've built even a basic emergency fund. I need to be blunt about this one, because it's the mistake that turns a good decision into a painful one. Picture this. You finally get motivated. You open an account, you put in a chunk of money, you feel proud of yourself, genuinely proud, and then 3 months later your car transmission dies, or your kid needs a dentist, or your hours at work get cut. And now you're staring at your investment account, watching it dip, forced to sell at exactly the wrong moment, just to cover a bill that has nothing to do with investing at all. That's not bad luck. That's a predictable, avoidable outcome of skipping a step. An emergency fund isn't the exciting part of this journey. It's not going to make you feel like a financial genius, but it is the foundation everything else stands on. Without it, every investment you make is fragile, because life doesn't pause its emergencies just because your money is busy growing somewhere else. The advice you'll hear most often is 3 to 6 months of essential expenses sitting somewhere safe and boring. A high-yield savings account, not the stock market, not a hot fund your coworker mentioned. Boring on purpose. That fund is what lets you invest for the long term without flinching every time something goes wrong, because something will go wrong. It always does eventually. The goal isn't to avoid emergencies. The goal is to make sure an emergency never has the power to derail your future. Let's get specific about what essential expenses actually means, because vague advice is part of why people stall out on this step. Sit down, and I mean actually sit down, not just think about it in the shower, and add up your rent or mortgage, your utilities, groceries, insurance, minimum debt payments, transportation. That number is your true monthly baseline. Multiply it by 3 for a starter emergency fund, 6 if you want more breathing room, particularly if your income fluctuates or you're the sole earner in your household. That's your target. It doesn't need to happen overnight. Even having 1 month sitting there, untouched, in a separate account you don't casually see when you check your checking balance, changes your entire relationship with risk. Suddenly a car repair isn't a crisis, it's an inconvenience. And that shift from crisis to inconvenience is exactly what protects your long-term investments from becoming your emergency fund by accident. One more thing worth saying plainly. An emergency fund isn't a sign of weakness or fear. It's not playing it safe in some cowardly sense. It's the financial equivalent of a spare tire in your trunk. You don't carry one because you're pessimistic about driving. You carry one because you're an adult who understands that flat tires happen to everyone eventually. And being prepared for that isn't paranoia. It's basic competence. I want to be clear, this isn't about hoarding cash out of fear either. Once that fund exists, once it's sitting there fully funded, its job is done. You don't need to keep padding it indefinitely at the expense of investing. It's a foundation, not a hobby. Build it once, maintain it, and then let the rest of your money get to work growing instead of sitting idle in the name of caution. Mistake number 3. Chasing trends and tips from social media. And look, I get it. You scroll for 90 seconds and someone with perfect lighting and a confident voice tells you they turned $500 into $50,000 with one coin you've never heard of. Or a stock is about to explode according to an anonymous account with a rocket ship in its name. It's designed to hijack the exact emotion that got you into this video in the first place. The fear of missing out, the fear of being late. But here's the uncomfortable truth about hype-driven investing. By the time something is exciting enough to show up on your feed, the easy money, if there ever was any, is usually already gone. What you're seeing isn't insider knowledge, it's marketing. Sometimes, it's flat-out manipulation, where early holders hype an asset up specifically so people like you buy in at the top, right before they sell, and the price collapses. This isn't a moral lecture about greed. It's about matching the tool to the job. Chasing trends isn't investing, it's gambling with extra steps. And gambling with your first real attempt at building wealth is exactly how people get burned so badly they swear off investing entirely for another 5 years. The instinct to want quick, dramatic results is completely human. But the antidote isn't discipline through gritted teeth. It's understanding that boring, unglamorous, diversified investing has quietly outperformed almost every hype trend over any long stretch of time. Boring wins. Every single time the dust settles. Here's a pattern worth recognizing, because once you see it, you'll spot it everywhere. Hype-driven content almost always follows the same emotional script. First, it manufactures urgency. This window is closing, everyone's already in, you're going to miss it. Second, it offers social proof that's impossible to verify, screenshots of gains with no context, testimonials with no names attached. Third, and this is the part that really gets people, it makes you feel stupid for hesitating, framing skepticism as weakness instead of wisdom. If something is triggering all three of those in you at once, that pressure itself is information. Real, sound investment opportunities do not require you to decide in the next 10 minutes at 11 p.m. scrolling in bed. Legitimate, boring index funds are sitting there tomorrow, next week, next year, available the exact same way they are right now. There's no expiring window on buying a diversified basket of the 500 largest companies in the country. Anything that insists you must act immediately or lose out forever is speaking the language of manipulation, not opportunity. I'm not telling you to never take risks, ever, for the rest of your life. I'm telling you that your very first investment, the one that sets the tone for your entire relationship with money going forward, should not be the one you learned about from a stranger's screen recording 3 hours ago. There's a simple filter you can run anything through before you invest a single dollar in it. Could you explain, out loud, in plain language, to a 12-year-old, exactly what this investment is and why it's expected to grow? If the honest answer involves a lot of hand-waving, buzzwords, or a shrug and a "trust me," that's not a filter you failed. That's the filter working exactly the way it's supposed to, protecting you from something you don't yet understand well enough to risk real money on. Mistake number 4. Not understanding your own risk tolerance before you put a single dollar in. This one is sneaky, because it doesn't feel like a mistake in the moment. It feels like optimism. You read that the stock market averages a certain return over time, so you go all in on something aggressive, something volatile, because the math on paper looks great. And then the market drops 15% in a month, which happens more often than people admit. And suddenly your stomach is in knots every time you check your phone. You can't sleep. You start reading news that only makes it worse. And eventually, at the exact worst moment, you sell everything just to make the anxiety stop. That's not a market problem. That's a mismatch problem. Your investments didn't fail you. Your investments were simply more volatile than your nervous system could actually tolerate. And nobody sat you down beforehand to ask the one question that mattered. How would you actually feel, not think, feel, if this dropped 20% tomorrow? Risk tolerance isn't about being brave or being cautious. It's about being honest. Some people can watch their account swing wildly and feel completely calm because they understand it's temporary. Other people check their balance and feel physically sick with far smaller drops. Neither type is wrong. But investing in a way that ignores which type you are is how people abandon good long-term strategies at exactly the wrong moment, locking in losses that would have recovered if they'd simply been able to sit still. Know yourself first. The portfolio comes second. Let's actually figure out your risk tolerance right now, together, instead of leaving it abstract. Picture your investment account dropping 15% in a single month. Not on paper. Really picture it. The number on your phone screen visibly smaller than it was last week. Now honestly, what do you do next? Some of you just felt your stomach tighten reading that sentence. That reaction is real data about yourself, and ignoring it would be a mistake. Other people read that same sentence and felt basically nothing. Maybe even a flicker of, okay, that's just how this works. Also, real data. Neither reaction makes you a better or worse investor as a person. It simply tells you how much volatility your specific portfolio should contain. If your stomach tightened, that doesn't mean you shouldn't invest. It means you likely need a portfolio with more stability built in, more bonds, more diversification, a gentler ride. Even if the long-term average return is slightly lower, because the version of the plan you can actually stick with always beats the theoretically optimal plan you abandon in a panic. If you felt calm, you may genuinely be suited to a more growth-focused, aggressive mix. The goal was never to find the objectively best portfolio in a vacuum. The goal is to find the best portfolio for the specific human being who has to live with it, checking their phone at 11 p.m. when the market has a bad week. That human being is you. There's no shame in discovering you're more cautious than you assumed. Plenty of people who think of themselves as bold and confident in every other area of life turn out to be genuinely risk-averse the moment real money is involved. And that's not a contradiction, it's just being human. Money has a way of surfacing feelings that don't show up anywhere else in your personality. So let's simplify the landscape, because most of the confusion around investing comes from information overload, not from the actual concepts being difficult. There are really only a handful of building blocks you need to understand at the start. Index funds and ETFs are baskets that hold dozens or even hundreds of companies at once. So instead of betting on one company's fate, you're spreading your money across an entire slice of the economy. This is where most first-time investors, at any age, end up living for years, because it removes the guesswork of picking individual winners. Fixed income, things like bonds or certificates of deposit, are the calmer cousin of stocks. They typically grow slower, but they move less dramatically, which makes them useful for money you'll need sooner, or for balancing out the bumpier parts of a portfolio. Real estate, whether that's owning property directly or investing through something called a REIT, which lets you invest in real estate without buying a building yourself, offers a different kind of growth, often tied to rent and property values rather than the stock market's daily mood swings. And then there's cash and cash equivalents, the boring stuff, high-yield savings, money markets, which isn't really investing in the growth sense, but plays a critical supporting role, holding your emergency fund and any money you'll need in the near future. None of these are inherently better or worse. They're tools. And the skill isn't memorizing which one is best, it's understanding which tool fits which job, which brings us to the next piece of the puzzle. Let's slow down on index funds and ETFs for a second, because this is genuinely the single most important concept in this entire video, and it deserves more than a passing mention. Imagine, instead of trying to guess which one restaurant in your city is going to be successful 10 years from now, you simply bought a tiny slice of every restaurant in the entire city at once. Some would fail, some would coast along averagely, a few would become massively successful. You wouldn't need to correctly predict which was which, because your slice of the winners would carry the overall basket forward, even while some individual restaurants inevitably close their doors. That's essentially what a broad index fund does with companies. You're not betting on one restaurant. You own a small piece of the entire industry. This matters enormously for a first-time investor because it removes the single riskiest part of investing, the part where you have to be right about a specific pick. You don't have to correctly guess the next big company. You just have to believe that, broadly, over long stretches of time, human economic activity tends to grow. Businesses tend to innovate, and productivity tends to increase. That's a far easier, far more historically grounded bet than trying to outguess professional fund managers who dedicate their entire careers to picking individual stocks and, statistically, still underperform simple index funds more often than not. One quick clarification, because this trips people up. When you hear the phrase, the market going up or down on the news, they're usually talking about a broad index, exactly the kind of thing we're describing here. So in a strange way, you've probably already been half following this concept for years, without realizing it applied directly to your own first investment decision. Here's the framework that actually matters. Match the investment to your timeline, not to whatever's trending this week. Ask yourself one simple question about any money you're about to invest. When will I actually need this? If the honest answer is within the next 1 to 3 years, a down payment, a wedding, a planned career break, that money generally shouldn't be in the stock market at all, because you can't afford for it to be down 20% the exact month you need to withdraw it. That money belongs somewhere calmer, cash equivalents, short-term fixed income, places where the priority is stability, not growth. If the answer is 5 to 10 years out, maybe you're thinking about your kids' education or a home renovation down the road. You can afford to take on more growth-oriented investments because you have enough time to ride out the market's inevitable dips and recoveries. And if the honest answer is, I won't touch this for 15, 20, 30 years, retirement money, this is where you can lean most heavily into growth, because time is doing the heavy lifting for you, smoothing out short-term volatility into long-term compounding. This single question, when will I need this, does more to clarify your first investment decision than any amount of research into which specific fund has the flashiest recent returns. Timeline first. Everything else follows from that one honest answer. Let's walk through a real example so this isn't just theory floating in the air. Say you're 38 and you've got $3,000 you're finally ready to invest. First question, when do you need it? If it's earmarked for a kitchen renovation you're planning for next spring, that's roughly a 1-year timeline. And the honest answer is that money shouldn't touch the stock market at all. It belongs in a high-yield savings account where it's stable and accessible. But if that $3,000 is genuinely extra, money you won't need for retirement, decades away, then a diversified, growth-oriented fund makes sense, because you have time on your side to absorb the market's inevitable ups and downs. Here's where people trip up constantly. They let the size of the number distract them from the actual question. $3,000 feels like real money, so it feels like it deserves a serious decision, maybe something that feels more sophisticated than a plain index fund. But the size of the amount has almost nothing to do with the right strategy. A $20 investment and a $20,000 investment, if they're both earmarked for 30 years from now, belong in fundamentally the same type of vehicle. Timeline decides the category. Amount just decides the scale. Mistake number 5. Putting everything you have into one single place. Maybe it's one stock you believe in because you work there, or love the product, or your brother-in-law swears by it. Maybe it's one property, everything tied up in a single piece of real estate. I understand the appeal. Concentration feels exciting. It feels like conviction. And every so often, you'll hear a story about someone who put everything into one company and it made them rich. And that story spreads because it's rare, not because it's typical. For every one of those stories, there are countless quiet, untold stories of people who did the exact same thing and watched their savings evaporate when that single company, that single property, that single bet didn't work out the way they hoped. Diversification isn't the opposite of ambition. It's just honest risk management. It's acknowledging that you cannot predict the future with certainty, no matter how confident you feel, and that spreading your money across many different companies, sectors, even asset types, means no single bad outcome can wipe you out. Think of it this way. If you own a small slice of 500 different companies through an index fund, and one of them goes to zero, you barely feel it. If you own one stock and that one company goes to zero, you feel everything. Diversification is how you get to stay in the game long enough for compounding to actually do its work. And staying in the game, quietly, consistently, for years, is the entire secret nobody wants to hear because it isn't dramatic enough to go viral. I want to tell you about a story that gets repeated constantly in finance circles, usually to make a point about caution, and I think it applies perfectly here. A well-known photography company, once an absolute household name, dominated its industry for decades. People who worked there, who believed in it, who'd watched it succeed year after year, understandably felt confident putting a large chunk of their savings into that single company's stock. Then digital photography arrived, and within a relatively short window, that company was gone. Not diminished, gone. The people who diversified, who had that company as one piece among many, absorbed the loss and moved forward largely unaffected. The people who concentrated everything into that one conviction lost a devastating portion of their life savings, sometimes their entire retirement plan, almost overnight. I'm not telling you this to scare you away from ever believing in anything. I'm telling you this because conviction feels identical whether it turns out to be right or catastrophically wrong, and you cannot tell the difference from the inside while you're feeling it. Diversification is the strategy that protects you specifically from your own confidence. which, statistically, is the single hardest thing for most investors, at any age, to protect themselves from. A simple gut check you can use going forward. If losing this specific investment entirely would meaningfully change your life for the worse, it's too concentrated, no matter how confident you feel about it in this particular moment. Diversification also protects you from something less obvious, your own future self changing their mind. The conviction you feel about one company today may simply fade in 5 years as circumstances shift, technology evolves, leadership changes. Spreading your bets means you're not locked into defending a single decision made by a version of yourself who didn't have the information you'll have later. So let's put this all together into a framework you can actually use this week, not someday, this week. Step 1. Before anything else, confirm your emergency fund is in place, or at least started, sitting in a high-yield savings account. Step 2. Get honest about your timeline. Literally write it down, what this specific money is for, and roughly when you'll need it. Step 3. Based on that timeline, choose the general category: cash equivalents for money needed soon, a mix leaning toward fixed income for the medium term, a mix leaning toward diversified stock funds for the long term. Step 4. Inside that category, default to broad, low-cost, diversified options, a total market index fund, or a diversified ETF, rather than trying to pick individual winners. This isn't the exciting choice. It's the choice that statistically outperforms most people who try to get clever. Step 5. Automate it. Set up a recurring, automatic contribution, even if it's small, so the decision only has to be made once, instead of being renegotiated with yourself every single month, which is exactly where motivation quietly goes to die. Step 6, and this might be the most important one, decide in advance that you will not check this daily. Set a rule. Once a month, maybe once a quarter. Checking daily doesn't give you more control. It just gives your anxiety more chances to talk you into a bad decision. This 6-step process isn't clever. It's not a secret formula. It's simply removing the emotional guesswork from a decision that emotion has been sabotaging for years. Let's turn this into something you can literally do tonight, right after this video ends, not as a metaphor, as an actual to-do list. Open your banking app. Check your current emergency fund balance against roughly 1 month of essential expenses. If it's there, good. Move to step 2. If it's not quite there yet, that's fine. You can build your investment habit and your emergency fund in parallel, splitting whatever you can contribute each month between the two, rather than treating it as an all-or-nothing gate. Step 2. Open whatever brokerage or retirement account makes sense for your situation. Many employers already offer one sitting there unused. Step 3. Select one broad, diversified, low-cost index fund. Not 5 funds, not a complicated mix you found in a forum post. One simple fund. Step 4. Set up an automatic monthly contribution, even if it's an amount that feels almost too small to matter. $50? $75? Whatever is genuinely sustainable for your actual budget, not your aspirational budget. Step 5. Close the app. Set a reminder to check in 1 month from today, not tomorrow, not next week. The entire point of this list is that it fits on an index card, because complicated plans get abandoned and simple plans get followed, and a simple plan you actually follow will outperform a sophisticated plan sitting untouched in a notes app for the 3rd year running. Print this list out if that helps you. Stick it somewhere you'll actually see it, not buried in a notes app you never reopen. The goal isn't to memorize a philosophy. It's to follow 6 concrete steps without having to reinvent your own willpower from scratch every single month. And if you slip up, if you skip a month, if life gets in the way, and you forget to check in for 3 months instead of 1, that is not a failure that erases your progress. It's a pause, not a collapse. The people who succeed at this long term are not the people who never stumble. They're simply the people who return to the habit instead of abandoning it entirely out of guilt. Now let's talk about the number itself, because I know it's sitting in the back of your mind. How much do I actually need to start? Here's the honest answer. Less than you think. Significantly less. Thanks to how modern investment platforms work, many allow you to begin with $50, even less in some cases. and automatically invest that same modest amount every single month. The amount you start with matters far less than most people assume, and the habit you build matters far more. Here's why. A person who invests $100 a month consistently, without fail, for 25 years, will very likely end up with more than a person who invests a lump sum once and then does nothing else, simply because consistency lets compounding work on a steadily growing base instead of a single frozen number. This should feel like relief, not pressure. You don't need to save up some intimidating 5-figure sum before you're allowed to start. You need to start with what you actually have available today, even if that number feels almost embarrassingly small, and let time and consistency do what they do best. The psychological trap here is believing that a small start isn't worth doing. But a small start that continues is worth infinitely more than a large start that never happens. Because it never happens, remember, for years, while you wait for a bigger number that always seems to stay just out of reach. Let's do some quick, honest math together, because numbers on a page tend to land differently than numbers spoken out loud. If you invest $100 a month, starting at 38, and that money grows at a historically reasonable average rate over time, by the time you're 68, 30 years later, that steady, unglamorous habit can realistically grow into a genuinely substantial sum, often well into 6 figures, sometimes more, depending on market conditions along the way. Nobody achieves that by making one dramatic, brilliant decision. They achieve it through $100 showing up on autopilot month after month, year after year, largely ignored, quietly compounding in the background of an ordinary life. Compare that to someone who tells themselves they'll start seriously once they have $5,000 saved up to invest all at once, and spends the next 4 years waiting to hit that number. That person hasn't been more responsible. They've simply been more delayed, and delay, in this specific context, is measurably more expensive than starting small ever is. The math doesn't care about the size of your first contribution nearly as much as it cares about how many months, how many years, that contribution had to actually work. Start small, genuinely small. The habit is the entire engine. The dollar amount is just fuel you can add to later. Let's bring this all the way back around. 5 mistakes. Waiting for the perfect moment, which never actually arrives. Investing before your emergency fund exists. Leaving yourself fragile. Chasing hype and trends that are designed to separate you from your money, not grow it. Ignoring your own risk tolerance until the market forces you to discover it the hard way. And putting everything into one place instead of spreading it out so no single bad outcome can take you down. Avoid those 5, and you are already ahead of a huge percentage of people who've been investing for years without ever addressing them. The framework is simple on purpose. Confirm your foundation. Get honest about your timeline. Choose broad and diversified over flashy and concentrated. Automate the decision so willpower isn't required every month. And then, and this is the hardest part for most people, let it be boring. Let it sit there, quietly compounding, while you go live your actual life. Here's what I want you to remember walking away from this video. You are not late. You are not behind some invisible schedule that everyone else is on. The version of you at 50, looking back, is not going to care that you started at 35 instead of 25. That version of you is only going to care whether you started at all. So tonight, not next week, not once things settle down, tonight, open whatever account you've been putting off, and put in whatever amount feels doable, even if it's small. If this helped clarify something for you, tell me in the comments which mistake hit closest to home. I read every single one, and if you know someone stuck in that same 11:47 p.m. search bar spiral, send them this. Subscribe for more of this. No hype, no jargon, just the honest, practical stuff that actually moves the needle. You've got this. Start small, start boring. Just start. Before you go, I want to leave you with one last thought, because I think it matters more than any individual tip in this video. Somewhere along the way, a lot of us picked up this belief that financial competence is supposed to feel like confidence, like certainty, like you finally arrived at some plateau where you know exactly what you're doing, and the anxiety switches off permanently. That's not how this actually works, for almost anyone, at any income level, at any age. Real financial competence looks a lot more like discomfort you've simply learned to act through anyway. You will still feel a flicker of doubt the first time you transfer money into an investment account. That flicker isn't a sign you're doing it wrong. It's just what it feels like to do something new and slightly uncomfortable on purpose, which, frankly, is what every meaningful change in a person's life tends to feel like right before it becomes normal. Give it 6 months, and this will feel as routine as paying a utility bill. Give it a few years, and you'll genuinely struggle to remember what the anxiety even felt like. That's not a promise about specific returns. Markets rise and fall, and nobody can guarantee outcomes. It's a promise about how habits work, which is something far more reliable than any single prediction about the market ever could be. If you take away exactly one sentence from the next 40 minutes of your life spent watching this, let it be this one: done, small, and consistent beats perfect. Large, and someday, every single time, in every single case, without exception. Thank you for spending this time with me today. Genuinely, that's not a throwaway line. Your attention is worth something, and I don't take it lightly.